So having said that, let's go into field underwriting. All right, man. So let's share that with you. And well, let's kind of cover, let's kind of do the setup. All right. So let me pull up my chat line. So if you guys have questions. Okay, so I'm going to explain. I got some splaining to do, Lucy. Of course, all you people, old people like me know that what that reference is. All young people have no clue. I'm not going to take time to explain it to you, but I got some splaining to do. So underwriting, how do insurance carriers look at the human being, you know, in terms of rating, right? And it'll be interesting to note that predictive medicine came out of the insurance industry. In other words, trying to predict someone's longevity, what's going to happen to them, has come out of the insurance industry because of actuaries, you know, math nerds that understand mortality rates as it relates to conditions, high blood pressure, diabetes, you know, all those things. Who has a propensity for stroke and, you know, heart attack, which are smokers. You know, that's why smokers pay double the rates, because actuarially they have a, you know, their death rate is twice that of a normal person. So predictive medicine came out of the insurance industry. And so the the insurance company wants to charge you exactly for what your underwriting risk is. It's all about risk management. And they don't want to produce a product and charge not enough for it, because as claims come in, as death rates start happening, they want to make sure they price the product properly for the underwriting risk that they're taking on. So it's all about risk and reward. Risk, and they got to make money, but they got to know what they can plan on as far as the numbers of people dying according to certain conditions, okay? So all insurance companies look at you, me, your kids, your parents as an underwriting risk. So if they're going to cover you, how and why would they cover you? And what are the risks in covering you, so they can charge you exactly what it costs to cover your risk in relation to the group of people buying the same product, okay? So the nice thing is for simplified issue mortgage term is what we cut our teeth on 20 years ago. It was designed as a product to cover your mortgage, right? And it was designed not to have to do any blood and urine tests, so someone can get it pretty quick. And then the insurance company would price it such that it would cover the healthy people and the sick people all with one rate. So it's like a one-size-fits-all rate. So you could be, you know, a little bit on the unhealthy side but still get it, or you can be perfectly healthy and still get it, but everyone pays one price. But you can get it without a blood and urine test, okay? So when you look at it, when an insurance company looks at you, they look at you in terms of health ratings. And so it really kind of breaks down very simply. And that's why fully underwritten products have all the different stratifications of ratings. You know, so for example, Foresters, they're like preferred plus, and I'm just going to go over non-tobacco rates, okay? So you got like preferred plus, non-tobacco, preferred non-tobacco. Actually, there's another preferred rating in here. I can't remember what it is. They have select non-tobacco. Basically, they got standard non-tobacco. There's another rating in here, but I'm going to show you what those are. But these are the 4 different ratings, and you get to standard. And then they actually have the table ratings. And so the table ratings are for people that are unhealthy. So when they do a blood and urine test, they can take you exactly where you deserve to pay based on your blood and urine test. So I think it starts at table B, which is a plus 50 for Foresters. And then I think C is plus 75. You know, D is plus 100. Okay. There's E and F, and it goes down, right? So if you were going to get a blood urine test, they peg you here, you get the best rate, or they can peg you right here, you get the standard health rate. Or they might say, man, you're at table 300 plus 300, and we're still going to cover you, but you got to pay a very large rate per thousand, okay? So that's how fully underwritten works. They want to know kind of where you line up, and then they're going to peg you and charge you for that particular policy for the face value. Like if it's 100,000, which is typically the minimum for fully underwritten, right? And whatever term is involved, you're going to pay according to how they rate you on this chart, okay? So how does this contrast with simplified issue term, where you don't have to do a blood and urine test? Well, what that product does is they cover the table D standard. So table D could be like oral diabetes or taking oral medications, usually diagnosed after the age of 50. Okay, no complications. They could be on cholesterol meds, right? They could be on, different medications, but they still can get the one rate for, simplified issue term, whether it's strong foundation or whether it's CFG, Safe Shield term. And so what they do is they look at, we can cover anyone above table D with no heart problems. Okay, hold on, I'm going to mute everybody.
All right.
Okay. So how simplified issue term works is they do table D standard, which means all these people can get into it as long as they don't have any heart problems. There are certain things that might be table D rated on fully underwritten. They just don't want to take the risk on simplified issue term. But then they do a standard one rate for all these issues. So, if you're super healthy, you might say, well, I want my best rate, right? Well, sir, do you know that your blood is perfect? Well, I had a test, a year ago. Okay, well, I mean, great, but you don't know if there's something wrong. And there are things that go wrong with people. Ask anybody who discovered that they had prostate cancer, where their levels were elevated, or anybody that had any issues. They're like suddenly, yeah, it's kind of personal, but unhealthy and or hazardous occupations, of course, yeah. If your occupations are hazardous, those things too. But I'm, just purely from the health perspective, you just don't know what's wrong with you until you get a blood and urine test. The problem is, if you don't know what's wrong, you could get declined, right? Like if you did a fully underwritten trying to get the best rate, they could decline you, right? Whereas if you tried to go through simplified issue term, you could have got the policy issued, right? But Alex, what can we, if he gets declined here, can he reapply under a simplified issue term? No, because once you know your health issue, they won't let you go the other way. You can only go from here to here. You cannot go from here to here. You can't find out you're sick and then get covered with a simplified issue term product. Okay, it just doesn't work like that. Okay. Oh, wow. So Dan's asking me, isn't this how Magic Johnson found out he has HIV? I don't know, but man, what a great example if that's the case. So where I get this a lot is from insurance agents that come in and say, well, why my client has to pay more for this? It's like, well, dude, tell me, what do you say to a client that gets declined on this, on the fully underwritten? Well, it's just the breaks. Seriously, that's the breaks? When he could have got 100,000, 200, whatever for his family, 350,000, I think, which is the max. And you just say that's the breaks? So now what's that guy going to do? An insurance guy who says that never has a good answer for me. Never has a good answer for me, right? Where we get these people covered, baby, and they got policy for their families. So that's why we like this. But understand that everyone pays the same rate to have the benefit of being simplified issue without having to do invasive blood and urine testing. That's a valuable thing, okay? So now how does this relate to the whole life product? Okay, so let's talk whole life. Whole life is simplified issue, okay? And whole life is lower, you're talking lower, you know, 2,500 to 35,000. You know, Mutual of Omaha is 40,000. You know, it's limited in scope for the simplified issue whole life. Now, if you want to do fully underwritten whole life, we've got products for that. The simplified issue whole life is just meant to be lower amounts of whole life insurance. And they cover to table F, which is like 6 tables. So this is where they cover all those things that you see in the underwriting guidelines, in the application. So it covers all of this, okay? So even healthy people getting whole life, you know, there's a whole life insurance, since it's lower face value, it's not going to be as expensive anyway. So we can get healthy people in it, sick people in it, sicker people. Then we, of course, we have the guaranteed issue whole life that covers anybody, okay, as a graded benefit, where, you know, the benefit's not available until 2 years. But this is how the whole life works. They cover all of this. It's meant to be lower. The price per thousand is higher because it covers a higher amount of risk. So notice table D has a certain rate. Table 6 for whole life has a certain rate status per thousand. And then all these have a rate per thousand according to exactly where the underwriting ought to be for the health, okay? So this is how underwriters look at your situation, your client's situation regarding their health, okay? So that's why we don't like to do fully underwritten, because the client doesn't know where they fall in the chart, okay? So that's why we, you know, we do the simplified issue term. So let's take a look at the rate difference and the price per thousand, okay? And kind of peer into that and see, you know, what all that looks like in terms of rates. All right, so this is a 50-year-old looking for 100,000 insurance, right? So these are all the different rates. This is your term. This is Strong Forrester's your term, okay? And these are all the rating categories. So this is, okay, the ones that I really kind of failed in telling you exactly what they are. So you got preferred plus non-tobacco, preferred, non-tobacco plus, non-tobacco standard. Okay, so these are all the things. So like, this is why I tell people, you got to do fully underwritten, always quote them at standard, at least standard, or if you know their health, then quote them at the appropriate rating. But these are so now the rated policy starts at plus 50, table B, okay? Then it goes to table C plus 75, okay? That's the copyright thing. I can't stop it from doing that. That's table C. Table D is plus 100, right? This is where the simplified issue term is rated to cover all the way up through table D. And then you got table E, F, H, J, L, and P. So I don't know what they did with all the letters in between there. That's just how they do it. So plus 125, plus 1. So these are all the ratings. Depending on the client's health, this is where they could peg somebody. So now look what the your term price is for 100,000 at the preferred plus non-tobacco, 36.67. And then as it goes up in rating, you can see how it goes up in price. So that's what, another $5. Okay, then you add another $7 or $6, you know, another $4, and then jumps up. So that's standard rating of 61.69, right? So it goes from 36.67 to 61.69, and then it jumps up because of the health rating, 96.52, right? And then it goes at 108, 126, 138, and so on. So if they should get plus 400, table P, which I've not really seen them approve stuff at table P, okay, it'd be 278.95, okay? So the yellow is table D, okay? So if you did cover someone that had table D health, right, you could, and they'd be paying 126.09, they could get a strong foundation for 97.21. Okay, so you see the price difference. This rate per thousand is $1.26. For the rate per thousand for the table D is 97 cents. Okay, and that's really kind of similar to the plus 50, right? So someone who is, definitely table D could get a good deal going through strong foundation. Now you're saying, well, this guy gets ripped off because he could have got 36.67. Well, he could have if he does get into this rating, number one, and only 4% of the population can fit into the preferred plus rating, okay? Only 4%, man. You're not talking anything more than that, 4%. So chances are I'm probably not going to get that, okay? So, but look, now you can, if you want, cover them with strong foundation. If they want to go fully underwritten later, they can. But most people just like making a decision, getting it done, and having it issued. And that's the value of doing the simplified issue term. So this is what we're talking about. Someone who's like up in here, this range, this is going to be a good program for them. Okay, strong foundation, because they don't have to go through blood and urine and risk getting declined, right? That's the problem. It's the risk of getting declined. Okay, so let's compare that to whole life. So what I did with whole life is I want to show you, because it's rated table F, okay, table 6, table F, you're going to hear that use this table 4, table D. So this is table 6. So it handles more issues. Now notice I show for plan right whole life, the max face amount is 35,000, okay, 20,000 and 15,000. And this is the rate per thousand. Actually, this is preferred, this is standard, and this is basic. Okay, so I did not explain that. The underwriting here, because PlanRight has ratings. This is the preferred. This is, I think it's called standard. And then this is called basic. All based on their health. Now the reason why I did different face value, because the max face value for preferred is 35,000. But notice if their health goes down, the max is 20, and then if they're not that healthy but still can get into the product, they can get basic, but the max is 15,000. But really more important is to show you what the rate per thousand is. So notice that the preferred rate per thousand, it's $2.97. But notice at the standard, it jumps up to $4.35, and then the basic is $4.56. So it's close, but look how much of a break they get at the preferred, $2.97. Now, whole life is whole life, meaning that it's designed to run the entire life of the client. So because it's what we call permanent insurance, it's going to cost more per thousand because, number one, it's guaranteed so that the price will never change. And if they keep making that premium payment, plus it earns cash value. So this is kind of how it compares. If you can see the term rates per thousand, for term, for a 30-year term, it's 37 cents all the way to $2.79. Okay, for the extremely sick person. Notice that strong foundation is 97 cents per thousand, but whole life jumps up because, number one, it goes to table 6 health-wise versus this is table D, this is table F. okay? So it's going to be more per thousand. In addition to covering more health issues, it's permanent insurance. So that's why it jumps up to $297, okay, or $435 per thousand or $456 per thousand, okay? Does that make sense? So now let's compare this to Smart UL. So in a situation where you have a client who's got fairly decent health and they want final expense insurance, what I might do is I might try to get them into Smart UL because they might get a better rate. Now, Smart UL is rated just like Strong Foundation, Table D, doesn't require blood and urine tests if you choose the non-medical version, okay? And notice the difference in price. So 35,000 Smart UL, they can get into it for $66.32 at the Smart Solve. Smart Solve premium means it'll go to age 100 based on the current interest rate. So that's pretty conservative. And so I will quote the Smart Solve. I'll never quote minimum, and I won't quote target. I'll quote Smart Solve because it's designed and illustrated to go to age 100, which is what whole life does. So this is more analogous. Now notice, if you wrote them with Plan Right, it'd be 104.12, but Smart UL is 66.32, as long as their table rating for health is Table D, okay? So sometimes I'll pivot to Smart UL because I'll get them a better deal rather than jacking them up with Plan Right. Now, I know you're going to get paid more if you did the Plan Right, but again, doing something good for the client is always better than doing something good for you. Now, if all things being equal, if it's good for the client equally, then I'd look for what's better for you. Okay, so I'm not dumb there, but this is another alternative, and this will also allow your policy not to be replaced by some yahoo that happens to talk their way in, and then they tell you about, well, I can beat that rate by $2. Well, it's going to be hard for them with a whole life product to beat the Smart UL rate. So in a sense, there's a way to protect, your client. You see how this works? So everything has a table rating. Okay, this is how they look at you. And then, boom, you can take care of it with our Simplified Issue products and not have to deal with blood and urine testing. Okay, does that make sense? Now, the question is on a whole life, how do you know what they fit into? Okay, that's the question, because CFG has their version of preferred, standard, and basic, which is elite, select, and advantage, I believe. And so it comes down to the application. So when you look at the applications, they ask very specific questions so they can knock out a client if they don't fit into a particular product, okay? So let me, and all the whole life plans follow this idea of knockout questions. So I'm going to pull up, and this all this stuff I'm pulling up is in your agent resources. So I'm going to pull up the medical form. Now I'm just going to pull up, let's see, forms. Columbia Financial Group, whole life. So let's look at the Ohio. So again, how do you know what to write a client? What is the underwriting principle behind it? Well, it's everything I mentioned. Now the question is, which version can they fit into? Well, let's just go through CFG. And this is what I went over with Courtney, and it doesn't hurt to go over it again, does it? Okay, so this is your Columbian Financial Group whole life, and I would suggest you do this for the Plan Right Foresters Plan Right whole life, Mutual of Omaha Living Promise whole life, the CVS Health whole life product, and the Mutual of Omaha Living Promise whole life, and then match them side by side. You'll notice that they all kind of have this idea of knockout questions as part one, and then the other questions that determine whether or not they're in the graded benefit product or the level benefit, but not as good as, CFG's elite product. So this part one, when you look at all these questions in part one, this is all related to knockout. So for example, is the client currently hospitalized, confined to a nursing home, hospice, bed, assisted living facility, etc.? If you say yes, then they can't get into it. You got the HIV, this one's also wheelchair. Are they wheelchair bound? They can't get into the product. And all these other things that are just major serious situations. This is how, when you're talking to your client on the phone, you can click off and find out if you're even in the running for a whole life product, like the CFG choice product. Part two, if you read the instructions, which I'm not very good at, ask my wife, reading instructions on how to put stuff together. Read these instructions because your income depends on it. So if any question in the section is answered yes, the proposed insured will be considered for classic advantage graded benefit, okay? So a lot of these will have numbers of years, how far back the client has dealt with this. So for example, during the last 36 months, have been diagnosed, received treatment, including taking medication for, and then it has kidney disease, kidney failure, liver disease, and so on. MS, Parkinson's, past 24 months, okay, for all those things. And past 24 months, you've been hospitalized or institutionalized for mental or nervous disorder, okay, past 36 months, And then down here, again, to determine if you can get the elite product, if you answer no to all these, then past 5 years, okay, in the 5 years, they ask a lot of the same questions in part two, but now it's 5 years to determine if you can get the elite product. So again, read the instructions, but all the other products are very similar. In fact, let me see if I can pull up Forrester's plan right and show you how similar it is. Now there are nuances, and that's what you're trying to find between the products. Some are a little more friendly to certain issues, right? So let's pull up a plan right app for Pennsylvania. They could be a little bit different as far as between even among states. So this is Forrester's plan right, okay? So here, notice, if a yes answer to questions 1 through 6, the proposed insured is not eligible for Forrester's plan right, do not complete or submit this application. So again, very similar. Are you a resident or have you been advised to move into a nursing home, skilled nursing facility, receiving or advised to receive skilled nursing care, hospice care, home health care? Again, so this is very similar. Notice here, using a wheelchair or electric scooter due to ongoing diagnosed illnesses, medical condition, or disease. So notice it's different than someone who had an accident or they did knee replacement surgery and they're temporarily in a wheelchair, okay? Requiring help taking or administering or taking your medications, or with bathing, dressing, eating, and toileting, and so on. So very similar, but they're subtle differences. Then question two, part two for Forrester's plan, right? Complete questions 7 through 12 and indicate the conditions to which each yes applies, okay? And then at the bottom of this section, it says, if yes answer in questions 7 through 12, then apply for Forrester's plan right basic, okay? If no to all the answers, then continue with questions 13 through 15. So you're still in the running for the preferred, but it says if there's an yes answer in part two, then you got to go through the basic immediately, like do not pass go, do not collect $200. All right, the part three, have you ever been diagnosed with, etc., then the instructions at the bottom, if a yes answer, then apply for Forrester's plan right standard. If all medical questions 1 through 15 are no, then plan right preferred, okay? So if they can make it through part 2 and 3 with a no, they can get preferred, okay? If there's no up here, but yes down here in part 3, then they can get the standard product. Okay, does that make sense, gang? So they all have this very similar thing to them as far as underwriting. Okay. So that is my class on field underwriting, understanding the table ratings, why they're priced the way they're priced. You know, simplified issue, the companies can only take so much risk without doing a full blood urine test, which is why the amounts of insurance are limited. So you'll notice that these companies have a limitation on the simplified issue term. It could be 250,000 or 350,000, okay? Whole life, right? As you know, 35 or 40,000 is the max for whole life. Now you can do an IUL with, it's just called express underwriting, where they don't have to do blood and urine tests with National Life Group's Flex Life 2 up to $1 million. You know, but what they're going to do is they're going to check their medication, the MIB and their medications and motor vehicle report. And if there's anything hinky that shows up there, then they're going to ask for a blood and urine test, okay? But if there's not anything crazy going on, they'll actually issue it, express issue without a blood and urine test. But they always reserve the right to, you know, request one, okay? So that's the risk you're taking with the Flex Life 2, which also is something you can do by electronic application, okay? So, all right. So that is it, man. Does anyone have any questions? Chat at me with any questions.